What's up, guys? Your agent Tyler Wayrung here, and today I'm here to give you an update on my investment in the Open Door Capital Heights on Katy's fund. So I know a lot of you guys have been following along to my journey investing with Brandon Turner's company, Open Door Capital. If you haven't, I'll give you the quick rundown. So I originally invested in Brandon's Fund 1, his original mobile home park fund for accredited investors. I put a $50,000 into that fund. Then a year and a half later, they exited that fund with a 35% IRR, which gave me roughly $85,000 back. Then I rolled that money into the next deal, which was the Cheval Apartments, which has been rebranded to Heights on Katy. Essentially, I enrolled $75,000 of my returns into this latest fund. They closed on that in 2021, and then fast forward to 2023, we actually stopped getting returns as investors, getting those monthly cash distributions because they're having some trouble with the property. So I've reached out. I've been trying to connect with Open Door Capital, and then recently I've had a phone call with them, and they've provided a more in-depth update. Let's go over and jump into my screen here. I'll first walk you through the latest update that we received on August 31st for the month of July 2023. While the property closed the month generating, here's the revenue, and occupancy is still up. As you can see, they're still working through some big concerns here. The big numbers to watch here, revenue, you can't get excited about big numbers. You have to look at it from a projected standpoint and how they're measuring up against that. So as you can see, slightly under from a revenue perspective. However, if we look at, we're only 3% below on revenue, but we're pretty significantly far on NOI and year-to-date NOI, which is, if you're not familiar, the really only number that matters when it comes to evaluating multifamily. So from an exit perspective, we have to get this number back up for us to hit the return benchmarks that we were hoping for jumping into this investment. The good news there is time frame not being super close, that we are looking to sell, at least nothing that we're being told or anything we can tell. Really, NOI is a current NOI, so we have lots of time to turn this around and still see the fruits of what we hope to get out of this. But currently, not looking good. No really way to sugarcoat that. So here's what I am excited about. In the past, I expressed my frustration with, they originally told us back in January or late last year about the distribution being paused because of, them having to solve for some things they were unexpected. That happens. We totally all get that. However, essentially, ODC went radio silent on returns for about 6 months. So they didn't say, hey, we're trending back in the right direction. Hey, here are the indicators we're looking for to decide whether or not to turn those returns back on. Is there even a chance we turn them back on, right? They just went radio silent, which I think, in any kind of crisis management, not saying that's exactly what this is, but no news is not good news. We want to hear exactly what's going on, even if it's not great news, because people assume the worst when you don't tell them anything. And so shout out to the ODC team. I thought they gave a very much more in-depth update here. So to better manage the cash positions and hedge the future risk, management decided to pause all distributions. No new news here. This is being done to accumulate additional reserves while we stabilize the asset, better understand what interest rates will be coming relative to how the asset performs once stabilized. Operating expenses have increased anywhere from 20 to 40% industry-wide from the previous year, which Heights on Katy is experiencing as well. We want to be fully transparent with investors. Hey, really appreciate that. On the headwinds that we've been facing and work towards a resolution to help ensure we navigate effectively as we aim to refinance in the next 18 months. The good news is August was our best month ever regarding occupancy and collections, revenues moving in the right direction, yada, yada. However, at the same time, with factors such as debt service and uncontrollable expenses continue to hamper the property's cash flow. As always, our primary objective is to keep the asset defensively positioned, yada, yada. Okay, so again, all that's good. We do want you to defensively protect the asset, hold those funds. And this is the part where I thought they did a great job at giving some operational context and, sharing kind of the bigger picture here. We know the news is not ideal, but rest assured, this is in order to best protect your investment. Here's the thing that they don't hit on enough, in my opinion. The cash we accumulate will sit in an interest-bearing account to help ensure we continue to obtain yield. So we are still earning interest on this money that's sitting there just because they're not distributing it to us. As a reminder, any pref return not paid will also accrue until dispersed, either when we're comfortable enough to begin that or upon a capital event. these accruals are paid out before any splits to the general partners. All right, so I think a lot of people are getting concerned with, hey, you're not distributing these. You guys are probably just keeping this. And so I think they're just reminding us here that, guys, the way this whole thing was written up in the beginning, what we invested in is that the general partners, being Open Door Capital, does not get their portion until the preferred return has been met, which is a 15% IRR. So what they're saying is, guys, don't worry, you guys still get paid. You still get your 15% before we get paid. So we are holding this. We are trying to earn some interest on these funds while it's sitting there. But once we distribute it to you guys, then essentially it's out and we don't have access to pull that back again. So I thought that was good context there. I'll continue here. Over the last several months, the property's debt service, this was another thing I asked them about. Can you give us some more insight into like exactly what we're up against here? Not that we can really solve it for you, but I think, as investors, we are limited partners in this deal. We want to know what's going on. Most of us investors are real estate investors ourselves. So we totally get the pickle that they're in. I think we just want to be more in the know and have some better insight. So I think they did a better job here. Thankfully, we do not have we do have an interest rate cap that protected us from being further exposed to rising interest rates, but we have still seen significant rise until rate hits strike at our rate cap. Okay, so before I jump on to over an insurance cost, I did want to share a little bit of additional questions I had of like, how are we subject to all these rate influences? Do we get a yearly adjustable arm? Like what kind of financing do we go into this with that as soon as rates go up, we're immediately getting hit with that? Shout out to Brian again, did share some better insight into the financing that we're in so that we, as the investors, fully understand the situation and can appreciate how they're handling it. So Heights on Katy is on a 3-year floating rate loan with 2 1-year extensions. So to limit the rate exposure, we did purchase a rate cap, like we said before. In comparison to the fixed rate equivalent loan at the time, again, this is back in 2021, this was a better option and more aligned with our business plan, as a fixed rate equivalent was significantly higher in overall interest, which, right, I think we can all, we know how that works. To get more certainty with the fixed rate, you're going to pay a higher cost to do that, as well as having much higher prepayment penalty. So if they were to pay the loan off early, they were going to pay a big penalty associated with doing that. That's something I've experienced in my market with commercial financing as well. So the current loan option provided more flexibility for a refinance or a sale, as well as much lower interest rate with a limited rate exposure, giving the rate cap in place. However, given the asset was purchased in 2021, prior to the surge in interest rate, the debt service cost still increased significantly, right? So I think basically in a nutshell here is, we went with a floating rate because it was a better cost for what we had planned for up front. However, no one saw the giant spike in interest rates, so that's where that hit them here. So I guess on a good front, when another buyer comes in, they go off a cap rate, which is financing agnostic. So basically, it's not factored into the equation. However, on the other side of the coin, when we start talking into insurance costs, that's definitely a part of NOI. And if we continue to see this increase, that goes directly to the bottom line that this asset will be evaluated on in the future. So let's look at insurance. Insurance costs have skyrocketed north of 30 to 50%, whereas typically we see 3 to 5. Going above, let's see, Heights on Katy alone saw $200K increase 2023. And are expecting further increases. We're continuing to shop this rate aggressively, and they are said we are receiving the benefit of lower rates relative giving our internal insurance agency. That's interesting to me. I did not know that that they had internal insurance. Okay, so jumping back, we will shop our rate aggressively, but this additional cash outlay and what it will do to our monthly payment weigh on our decisions around distributions. Totally understand that. I don't know what to do in terms of insurance. They kind of have a captive audience there, especially if all carriers are, doing the same thing. That one's a little scary to me. I'm not gonna lie. I guess it sounds like, a lot of the other things that Texas, I'd say natural disasters-ish that they've been having are likely a good indicator on why those rates are increasing. But the scary part is we don't have any control on that. And if we continue to see that, this could get pretty ugly. So renovation costs have also increased significantly, forcing us to explore additional cost-cutting options. Again, I guess the only downside is I'd want to hear more about that. instead of more of like just the fluff. This is kind of the standard fluff. Again, as investors, we want to know, what are you doing? It'd be interesting to hear what cost-cutting options are you looking at. Slowing down renovations sounds like a plan. Another unique challenge that is interesting to me is that the lender has not been releasing the CapEx funds due to rising interest rates and lower debt yields. The lender has only reimbursed from escrow $400K of the 1.6 that we spent on CapEx. So if you're not familiar, the way this works is it's almost like when you're building a house, you have milestones in place and say, hey, we'll get the foundation laid. Okay, now you reimburse us for the foundation. Then you go on to, you front the money for the framing. Oh, we'll reimburse you for that. Well, it sounds like they spent all this money. Part of the plan that they laid out with the lender, however, the lender's saying, whoa, we actually can't reimburse that because we're kind of looking at our risk mitigation strategy as well. They want to be smart about the funds they do release to the do ODC. So that one's a little scary as well, and I'd be interested to hear how all that shakes out. Okay, so the property does, however, show well with exterior CapEx completed. Now that the asset is stabilizing, operations are getting laser focused on driving top-line revenue and trimming back expenses. Again, would love to hear kind of more in the weeds on what those things are that you're doing there. I'm always curious when they say, or anyone says, now we're really focused on top-line revenue. It's like, well, were we not before? Or, you can only do so much to increase top-line revenue. So that one always is a little tricky to me. Let me know in the comments if you agree or if I'm just totally missing something. And that's a normal kind of phased approach that you focus on, expenses or CapEx, and then you focus on top-line. I'd be interested to hear your thoughts in the comments there. Okay, we will continue over the next 6 months in order to be aggressively trending our NOI to put us in the best position for a refinance. One of our main objectives is to build up the reserves for a refinance, given the current market interest rates. Our primary focus at HK is continuing to drive NOI. Okay, the only other thing, I think the negative that I'll share in this, and this is completely my perspective. They haven't communicated anything around this yet, but I did want to share, I think initially I was excited about the idea of a refinance kind of helping us out with the operational expenses in the short term. If they refinance and keep the current term, right? I'm sure you guys are familiar with what a refinance does, lower your monthly payment. However, what kind of rates are we going to get if we continue to see rates increase? Is that going to help us out at all? Like if we extend the term but get an overall higher interest rate, is a refinance the right decision? I can't answer that. I don't have all the variables needed to do that. The other thing is, if you're not familiar, ODC as the manager are entitled to capital transaction fees, which could be a sale, but they also get 1% of the new loan amount in the event of a refinance or a sale amount in the event of a sale, right? So what I just said. So essentially, a refinance could benefit ODC in the short term and not the investors. So the one reason I do love these kinds of deals is typically all of our interests are aligned in terms of getting us the 15% preferred return and splitting everything above that, right? That keeps everybody on the same page. We all need to drive to, hit the same metrics. However, when we start to look at these refinances, there's only one beneficiary of a refinance, unless I'm missing something here. So what I would love and what I would expect, and in fact, I guess the only way to answer this is what would I do if I were in their position? All right, we have a troubled asset. We haven't been able to live up to what we originally planned to do and give these investors their monthly distributions. If we decide to go through with the refinance, we will forego our fee associated with doing that in the interest of the long-term projections of this property and to keep everyone's interest aligned into the 5 to 7 year plan rather than us cutting you another check as the manager when we really haven't seen this property really come to fruition at all. So that's the one thing that does worry me. However, if we get past that, and it'll be interested to hear their thoughts once we get closer. Obviously, we're 18 months out right now, so it doesn't really help to speculate too much into the future there. But let me know your thoughts about that as well. Do you think they're entitled to the 1% fee just for kind of keeping this thing on the rails, or what would you do in that situation? Love to hear some other investors' thoughts. So obviously, lots of long-term potential, but I think lots of short-term hurdles that we have to solve for. before we start to see what the potential might turn into in the future. So guys, that's the update this month and my thoughts about it. I'm still keeping my optimism for the long term. And if I missed anything or you have other thoughts, again, would love to hear those in the comments. Those are the best place to have a conversation around what's going on there. But guys, I appreciate you sticking around, continuing to support the channel, and I'll keep you updated as I learn more information about what's going on with this fund and ODC in general. But with that, guys, I'm Tyler Wayrung, and we'll catch you next time.